But we have a lot of stocks in focus, and one which is in focus right now and is seeing a sharp cut despite a margin improvement on a Q-on-Q basis is Strides. In fact, the margins have come in at a multi-quarter high, but the stock is still down around 6 to 7% at this point in time. To talk more about this, as well as the proposed restructuring that the company has announced, we have with us Mr. Arun Kumar, who is the Group Chief Executive Officer and Managing Director, joining in. Mr. Kumar, thank you very much for taking the time out. If you could just start by addressing some concerns which, providing us more clarity with regards to the restructuring that the company has announced on page 16 of the investor presentation, where you are looking to combine your CDMO interests of the group under Strides. That means that there is a promoter business of the company, of a CDMO business, which is run by the promoters, which is now going to be housed under Strides?
Yeah, thank you, Ekta, for the opportunity. But before we start, yes, we did. We have come back very strongly after a difficult post-COVID reset. And our numbers obviously are the highest ever reported. But coming to your specific point, one of the key concerns that we have addressed is to bring all the promoter interests in the CDMO businesses under the Strides umbrella. This is something which the board has in principle agreed to undertake an exercise of appointing bankers and valuers. This will get over in about 12 weeks when we will be able to give you much more details. The idea here is that now that we have solved for Stelis and the issues related to Sputnik, and we have sold an incremental asset to Syngene, we are now in a strong position to build out a biopharmaceutical CDMO. But to be a completely focused specialty pharma CDMO is what we are now driving. And then for it to be housed as part of a division of Strides, therefore, all promoter and public interests are aligned. So that's the primary focus of the exercise that we are proposing to conduct.
Okay. Can you give us a few more details? This CDMO business, which is run by the promoters, how big is it? Is it supplying to innovators or generic companies? Is it profitable? What would the margins look like? And also the second part of it is that Stelis will house additional group businesses. More clarity on that.
So Stelis is the biopharmaceuticals arm of the CDMO business. The entire CDMO business will sit in the Stelis arm once it's approved by stakeholders and lenders. Under this, there would be certain CDMO businesses of Strides that will move on. But more important, there will also be the part of the injectable CDMO business, which is currently privately held, which will also move in to this particular division. All the CDMO businesses that are currently proposed to be brought into this new venture are profitable and are very accretive to Strides shareholders.
Okay, so just a quick clarity. What would the combined entity look like? Will there be any kind of investment which will come through from Strides? And what will Stelis hold?
So to answer your point, like I said, it will have a combination of assets that Strides has of its CDMO business merged into the Stelis biopharmaceutical CDMO business and the injectables CDMO business that we own as a family office. All of this will incrementally add about $100 million of CDMO revenues to Strides and will make us one of the more larger top 5 CDMO companies in the country, but operating only in specialty pharmaceuticals.
Okay, got that. Thanks for joining us, Mr. Kumar. This is Pavitra. Let's also talk a little bit about your, just the Q1 numbers that came through. I'm looking at the revenue. It's very flat if I look at it on a year-over-year basis. Sequentially, there's around a 5% decline. What led to that decline that we've seen in this quarter? And also, how do you expect the coming few quarters to really pan out?
So adjusted for continuing businesses, the growth on revenues is about 11%. It's not on YOY basis. Our focus has been the margin expansion. As you can imagine, we have improved our margins now consistently for 3 quarters in the 58 to 60% range. Our EBITDA growth has been 3.5 times Y on Y. So that has been our primary focus as a company to get our margins up, which we have now, and to focus on free cash generation, reduce and focusing on the balance sheet. Revenue growth is an important part of the strategy, but typically being an acute products company and acute therapy player, historically we have a strong H2 and a slightly muted H1. This has been the case for several years, and it's no different from where it is. So from a historical standpoint, this is our best ever quarter reported in the lean season, if I may. And I'm very confident from here on, both growth and margin expansions will continue.
Okay. Just quickly coming back to the restructuring, Mr. Kumar, if you could just tell us what will happen to the promoter stake as a whole on a blended basis. How much will the promoters hold in the entire entity? And secondly, you've also approved the merger of Vivimed Life with the company. Explain that to us.
Yeah, let me take Vivimed. Is a lot more easier. It's 100% subsidiary of Strides. So that is just making life a lot more easier from an operational standpoint. So we are now bringing Vivimed as, just reducing the complexities of our multiple subsidiaries and operations into one single entity. As far as the valuation of the CDMO business, and answering your question in terms of ownership, it's very early days for us to talk about this today, simply because the valuation exercise is just about in the process of getting completed. It will then go for fairness opinion, for which an international banker has been appointed. And all of those finer details that you're seeking will pan through only after we have that exercise completed.
Okay, got that. Mr. Kumar, we also want to talk to you about the debt that we are seeing right now, because like we were talking about Stelis and the fact that it's been sold to Syngene for around 700 crores. Can you tell us how much of the debt will be paid down right now, and could the reduction that we see now be more than what was earlier anticipated as well in FY24?
So when we guided that between Strides and Stelis, we'll reduce debt by 500 crores. This is on top of the over 500 crores that we reduced the previous year. With the Syngene transaction, I can now confirm on closure of the Syngene transaction, that 500 crore number would have been achieved, if not exceeded. So consequently, we believe we can now aim at a debt reduction upwards to about 700 crores, given a strong free cash generation starting from this quarter. So I see this to be a significant positive, and that's another reason why we timed the restructuring, or proposed restructuring, because we bring all our interests under one umbrella and make Strides a much larger and stronger company in the near term.
Okay, just quickly, Mr. Kumar, if you could just leave us with what the margin picture would look like, as well as the US business. You were doing $60 million in terms of a quarterly run rate. It's come down this quarter. What would it be in the next couple of quarters in terms of revenue? As well as margins, you were targeting 20%. When do you expect to get there?
So, Ekta, I believe we'll exit at that 20% margin run rate. And if you look at our US numbers, historically, Q2, Q3, Q4 are the build-out quarters, typically over many years. So we have grown the US business this year by Y-on-Y by almost 30%. So it's been a good start to the year, and I think we'll get back to our steady state $60 million run rate starting from this quarter.
Okay. All right, Mr. Kumar, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So there is a little bit of recovery which has taken place in the stock as we speak, which is down around 5.6% as opposed to a close to 7% cut when we started the interview. But nonetheless, more clarity is awaited with regards to the CDMO restructuring, which will probably come in the next couple of days.